So where are we today?
Well, I think that, there's been the sense, as you just saw with the WAG news, there have been these companies just have raised an extraordinary amount of money and have been pitching themselves as tech companies that really weren't tech companies. WeWork was not a technology company. WAG is not really a technology company. And the combination of trying to get these technology valuations on companies that shouldn't be trading that way and companies that are just raising too much money and have no financial discipline, hopefully some of that is coming to an end, but I still think valuations are going to be pretty crazy for a while.
What do you think?
Look, I think, if anything, this signals the beginning of the end of these shoot-the-moon sort of business plans. And what I mean by that is they don't work for two reasons. One, companies are raising a tremendous amount of money, and they do that primarily to try and have some sort of competitive advantage versus their competitor. But all that does is actually just drives more money, more funding to the competitors. So it actually makes it easier for the number two to raise money, not harder. And then, look, I think on the second issue really is that once you are running one of these companies, you realize that running a company is all about managing habits. And if you have a habit of managing a company at a really high burn rate, it's very hard to then make a right-hand turn into fiscal responsibility. And so if you've raised the money, the capital sitting in the bank, you're going to end up spending it. And I think that's part of the problem is you heighten the risk that you're not going to make the metrics for the next round. The public markets are beginning to obviously figure this out. You can look back at this year, go look at Zoom as a great example of a company that went public, had great metrics, was growing over 100% year on year, had great net dollar retention, but also was free cash flow positive. And from a performance standpoint, that stock today, I think, trades at 40 times sales and 400 times forward earnings. And the reason why investors give it that leverage or that latitude is primarily because it's working on the unit economics.
Just to jump on that, I think the retail investors, public market investors, have gotten a lot more savvy about the difference between growth with great unit economics. So Amazon, hey, if Amazon's not profitable for a couple quarters, we now know, and we've learned the lesson, Amazon knows the day it wants to be profitable, it can spend less on marketing or cut back on R&D and drive tremendous profits. Growth with great unit economics, like an Amazon or a Zoom, will pay for that. Growth at all costs with poor unit economics, while you're seeing a bunch of these companies trading below their listing price.
I mean, that's over now, though, right?
Yeah.
Growth at any price. Can we say that's done?
I think growth without unit economics that work, people are onto that, and I think that's going to be over, at least for a while.
It's no wonder you guys talk about Zoom. It's no wonder if you look at the best performing IPOs of the year, Zoom's like right up there, second best. I mean, the stock's up 81%. Sure. If I had told you at the beginning of the year that Uber and Lyft were going to do so poorly and that Beyond Meat was going to be up 200% or thereabouts and Zoom and CrowdStrike would do so well, you would have told me what at that time?
Well, look, I think Zoom and Datadog have two very unique specific attributes about the companies in that they're SaaS companies with great recurring revenue streams, have high net dollar retention, which means if the business stopped today, it would keep growing from a revenue perspective just from its current customer base. And then they both were free cash flow positive. And so I think both of those things show that those are good plays. I think the issue with Uber and Lyft ultimately is a bit of this, you're trading on someone else's capital for a bit. Uber and Lyft essentially have massive stipends and bonuses that they pay drivers and drive the incentive wheel in that way. If they take that away, ultimately both of those companies will be highly profitable. It's just a question now of who moves first.